So if I put 1 here, it will be 0. Obviously, 1 minus whatever is that would be my allocation. In which case, my portfolio returns would be weighted. Average of Nifty, that's locked. Come on. What's happening here? I can increase this in or decrease in 0.5 steps. And obviously here it will be 0.05. I don't understand how it became. Right. So if you do 50-50 allocation, we get about 1.10%. 1.09. If you do only Nifty, we get 0.92. If you do only IT, we get 1.26%. Now calculating the standard deviation of the portfolio, because we want to get Sharpe ratio, is little tricky. So just search variance or standard deviation. Either Wall Street Mojo or Portfolio Investopedia. These are the two standard sites that I would recommend. This is variance. What is the variance to standard deviation relationship?
Standard deviation is square root of variance.
Variance, right? So we can, if we calculate this, we can calculate standard deviation by square root. So portfolio variance is weight 1 into sigma 1. That is standard deviation of the asset 1. Then weight 2 into sigma 2. That is standard deviation of the second portfolio. So these are actually squares. Then 2 into W1 into W2 into covariance of 1 and 2. Covariance is basically P of 1, 2, that is correlation, into sigma 1 into sigma 2. Or we can do this covariance of 1 and 2. Because covariance is little not intuitive number for us, we'll do correlation with. So this one will become correl of 1, 2 into sigma 1 and sigma 2. So we need to calculate correlation. We have everything else. Okay, the standard deviation is variance square root. So whatever you square into another square, it's a positive number, right? Yes or no?
Yes.
Positive number, and this is again a positive number. So another big positive number will come. Now, what is Sharpe ratio? What is Sharpe ratio?
Average divided by standard deviation.
Now this has to be high. Can't
Yeah.
manipulate average, because once average is fixed, it's fixed. Choose higher average numbers by high return assets. Barring that, how can you increase Sharpe ratio?
Lowering the standard deviation.
Lowering standard deviation. Now, in this standard deviation equation, we added already two positive numbers. So it has become bigger positive number. So how can you lower it?
Correlation to be negative.
So here, the way to reduce standard deviation is, if you can get this correl as a negative number, you will reduce, because this is a positive and a positive number, maybe a negative number, so everything will reduce. So thus your standard deviation will reduce. So that's the whole funda of choosing negative correlated assets. Because in this equation, for reducing this number, we need to reduce this number because this needs to be higher. Let's get this equation here. I'll paste everything here so that what is this W1 square into sigma 1 plus square into in this I need to lock J plus 2 into everything. Standard deviation is square root of this. Where is the highest Sharpe ratio? Because you can't read this number. Everything is same, right? 0.22 and all this. Maybe multiply by 10. Where is it highest?
Forty-five, 55.
2240, right? That tells 45 into Nifty and 55 into IT. That's where your highest Sharpe ratio. And your returns are about 1.11%. Now, instead of making a graph like this, you can solve also. So let's say 0.5. I just took some number. I want this to be maximum. So how many of you used Excel solver?
Yeah,
How many of you are data engineers? So you might not have come across. Okay, so do like this. More options. Add-ins. Then Excel add-ins, go, solver add-in, say okay. Once you do that, what you will get is, if you go to data, you will get something called solver. Right? What is solve? Solve what? This, which is Sharpe ratio, I want it to be maximum. How? By changing this number. If I change there, everything will change. Solve. So those numbers changed, 47 and 53. And the equation is 2241. When solver, you can add certain constraints. Like by chance, if this equation tells me it will go to 0.05. So no, I don't want it to be so low. I want at least 10% allocation. So add that constraint. Add this cell to be greater than 0.1. This cell also to be greater than 0.1. And then options. Sometimes because I'm in a hurry, I don't want this equation to be solved forever. I'm just giving you 30 seconds. And solve. So when you are solving here, the iterations will come. It's the same because it's already solved. This is how you allocate two portfolios. Now, because you have a template, you can choose multiple asset classes. Right. So now, if I want to do for IT and FMCG, how do I do? How do I do? How many of you have a comp?
I have one.
No, the new guys. Hello.
Yeah. Hello.
Yeah, who is this?
This is Vinay.
Not Vinay. There are 4 guys who paid for this course.
Okay.
Shabuddin, do you have comp or no?
Yes, sir.
Okay, what I'll do is I will send you the sheet. You share the screen with me. So I'm stopping the share.
Should I share the screen?
Yeah, I'm sending this. I don't know where I stored this. Store this. What's your email ID?
Shahan.097. Wait, I text it.
Yeah, share your screen. Where's the email that I sent? What we need to do is just copy that two port allocation to another sheet. Just make a copy on the down. Right click, move or copy.
फोन नहीं लग रहा है उनका, क्या प्रॉब्लम है बताना।
Okay, now go to BS India.
ऑनलाइन अपॉइंटमेंट हो गया?
Guys, please mute yourself.
क्या प्रॉब्लम है?
Hello.
हाँ हाँ, मैं मंडे से नहीं हूँ।
Market data products.
आर्बिट्रेशन नहीं है। हाँ,
Now go up market data.
तो ये ला डिपार्टमेंट से कहा था, वो कोर्ट केस है ना अभी। 24th जाएगा।
काम हो जाएगा तो शाम को रिटर्न आ जाऊंगा।
पापा से अलग है तो सब लोग जा रहे हैं?
मैं और पापा,
बाकी लोग नहीं?
बाकी लोग क्या?
मामा इधर है ना?
Equity. No. Then come down. ETFs. No, there's somewhere the historical data, not that one. Go up. Yeah. Equity, historical stock prices. No, equity market capitalization. Now select gold. MFs and ETFs. Gold Bees. From just put monthly. January 2010. Actually, December 2009. Submit. download the data. On the top or down. That. Yeah, so what it is it is in reverse, right? So sort, select all, sort, oldest to newest, newest to oldest. Yeah. Now after F, you insert a column. After E, you insert a column. Now if you come down, see the gold was split, right? Earlier it was 2000, now it is 40. So from that date, you have to divide it by 10 or 100. Go up. Where it is, stop there. Where that it jumping, come to that place. Equals to that divided by 100. Copy that. No, for the other things you don't need to, only for the previous data. Now go up. From that point where you've done by 100. So from there, 34 onwards, it's equals to. Yeah. Correct. Now go up, take it up. Now in the G, insert one more after F. That is T%. Actually not T%, gold percent. Equals to F2 into 100 divided by F3. Minus 100. Now get this data. Copy. Actually, I had to copy only from July. Or delete August. Delete August. Get that, copy, and paste it in IT as values. No, as values. Is it correct? Just check once more. Yeah, come down. It's giving error because it has excess data. Delete all that data. The due by 0. Now change IT to gold. All right, now solve the equation. Excel options. Excel options. Go to data. So your solver has come now. Target cell as M32 by changing H32. Guess. Solve. Keep the solve. So it changed. Now whether it changed or not, you again reset it to 0.5 and again solve. So it changed values, right? So that's your allocation, 46 and 54. Right? Go up. Sorry, come down. Actually, go up. D will be portfolio returns. D1. Port percent equals to B1, B2 into get that cell number. I don't know what is that. Come down. Where you solve, no, that put that H32. H32. Lock it. Function F4 or $. Plus C2 into the same H33. No, come down and put it. Lock it. Nothing, no, only I32, right? Enter. Take these values. Make backtesting matrix, make a copy of that. Go to your so you can get that, D, copy, and paste it in G. Paste it in G as values. Values only. Is it correct? Minus 4.25 is the end. Yeah, correct. Now come to your backtesting matrix. So instead of IT, it's portfolio, right? Let that be. Actually, that has no value. I mean, that is not operated. You can delete, but keep it. Now, what happened here? P are your metrics, and M is benchmark Nifty. The CAGR is the same. 9.95 versus 9.74. Your maximum drawdown has improved drastically, right? Your 100 is the same. There's not much difference. 329 versus 322. But what you achieved is a higher Sharpe ratio. Earlier it was 0.64, now it is 0.96. and you have the same returns, your beta is reduced considerably, and your R square is only 44%. And even though your returns are same, your risk adjusted returns are increased dramatically to 6% or 0.5% per annum per month. Right? Now you are getting the hang of it, right? You save this sheet and send it to me. Save Nifty 50 data underscore your name.
Got a few questions. I mean,
Yeah. Close it and send it to me. Yeah. Ask.
So the way you would probably go about it is first select which sector is doing best by looking at the Sharpe ratio, and then decide top 2 or top 3 based on your Sharpe ratio.
Correct.
Based on that, you use this to figure out what percentage of the allocation should be there in that for your portfolio, right?
If it is only 2 portfolios.
So this can only be done for 2 or can be done for more than 2?
It can be done for more than. So let me get his
Okay.
sheet. He hasn't sent it to me yet.
Send it, sir. Send it.
What's happening here? Yeah, you can ask me the questions. One thing I want to show you is this one, right? This is today. Suppose we go back to, let's say, at the start of 2021. So I would have only seen this data. Now I solve it. So 4654, just remember those two numbers. Not much change, right? $43 and 57, it said. So that's not a much change. So the point that I'm trying to mention here is it won't change much the ratio when it hardly changes. So you don't need to do every month. You just stick to what's your yearly schedule. It could be March end or it could be December end. December end for the US folks and March end for Indian folks. Keep doing this. Just that small minute change you reallocate. So you don't pay tax. Ideally, this is 43 and so it is 46 now. So that means you have to put additional 3 rupees into this, whereas you have to reduce. So instead of selling this 57, 3 units, 0.3 rupees, right? Your new money will come. Obviously, we'll put another 100 rupees. So you adjust it like that. So the way that I would do is, earlier it was in 46 and 54. Obviously, this would have also gained something. Assume it hasn't gained anything, it is staying there. Now I have to get it to 43 and 57. Obviously, I would be putting 200 rupees now, right? So I will buy this much gold instead of selling the Nifty base and getting a tax implication. So I'll buy 49 gold and I'll buy 51 Nifty. So I get to new ratio, which is 46 and 54. Right? Does this make sense?
Yeah.
Now we have Nifty and IT and gold and let's say Nasdaq. I will give you the pointers to a lecture which explains a step-by-step process. What you need to know is a little bit of matrix multiplications to understand what's going on. Nifty, this becomes my gold. Then I need Nasdaq. Okay, the first step is something called D-mean. That is, take the entire average and minus it from current month returns. So this is the D-mean data of all the indices. And let's put from 2000 end onwards. 2012 end. So I'll delete all this data. So after demeaning, your first step is just 0.25 to everything. Allocation, then transpose. This is mmult transpose J2 to M122. So what data we have here? We have all the way to only 116 because we don't have the data for NASDAQ. So that's why it's giving error. So this will become 116. And Control Shift Enter. What is the count? So that's 115 data points. Then where per metrics. This is R5 to U8, R5 to U8 divided by R10. Then a standard deviation. It is nothing but standard deviation of this array and this array, this array, this array. Then product of SDs. Some matrix multiplication and transpose, and then you get a correlation matrix. So this is your correlation. Nifty to Nifty is 100. Nifty to IT is 45. Nifty to gold is negative 15. Things like that. Various. So this matrix has to be 1, 1, 1, 1. So I don't know why 0.9 has come. There is some error in this case. It is changing a little bit, but that's fine. Ideally, it should be 1. And this is initial, just 0.25, right? Weights into SD, then some calculation, then this is actually the variance. Right, square root of that. And portfolio returns are nothing. Weight into returns into 12 or something like that, into 12 because 12 months. And portfolio variance, this is monthly variance, so you are converting into yearly by a square root of 12. And again, converting back to standard deviation, square root. So now you have your Sharpe ratio, which is portfolio returns divided by standard deviation. Data solver. Solve what? This one to be maximum by changing these variables. Just say solve. What it has done is it has gone berserk and put all the weights to whatever it wants, because all that we asked you maximize Sharpe. I don't want this way. I want a constraint. What is a constraint? What is a constraint?
One, sum should be one.
So add now solve it. What's happening here?
Ora, I think you have defined weights in the above cells, not there. Just maybe.
Yeah, sorry. It's Mm. Correct. So it's not here. It is in R42 to
Maybe constraint needs to be at R45.
I need to give some seeding value, 0.25 or some number, then it solves. Now the problem here is, yes, we achieved a higher Sharpe ratio. Earlier it was 5 or something like that. Now it has gone to 6.6. But it is not allocated anything to IT and NASDAQ. So you can add, at least I want 10% kind of stuff. And I don't want gold to be 52, like both conditions, right? So add this to be greater than at least some allocation, not 0% or 0.9%. One more we have to add, right? 42. We'll just observe what ratio it will become. Okay, so now gold has come almost 50% weightage. Again, you don't want to be in this situation. you want it to be less than 40%, or maybe less than 33%. It decide, I mean, there's no right or wrong answer. So put that constraint, now you get a ratio. So now it is at 6.5%, the Sharpe ratio. What is F70? Okay. Q2 is there's no 100. This is what it is. So your 100 has become 267. Now, if you want to compare with your benchmark, we are in line with Nifty with a better Sharpe ratio. We are now short of almost 1.07, but our returns have reduced by 1%. But our MDD is much better now, right? I mean, what benefits you got? You have reduced your returns, so obviously you should have got additional benefits. What are those additional benefits? Yeah, you can answer now. Answer.
Drawdown went down.
Drawdown went dramatically, right? So 9% down means you won't get scared.
Drawdown went down, standard deviation went down.
And your beta is also much lower now. R square is also very, very low. If somebody packages a portfolio like this, I might pay. Even though my returns are less, I have a reason. My returns are less, but my drawdown is much, much lesser than your benchmark. And I'm non-correlated. Our R square is only 32%. Because beta is lower, I'm able to generate alpha, even though my returns are less than the benchmark. Right?
Yep.
Now this 4 portfolio to make it 6. Copy. You need 2 more rows here, right? Who wants to try this? And I need 2 more rows. Who has the comp? See?
I'll try another one. Maybe this someone else can try, and then I'll try another one, the last one.
Who wants to try? Quick. Kanai, are you there?
Yeah. Yeah, I won't be able to do it. I am not on a computer. Sorry.
Okay, who else is there? Vinay or Rachit?
Yeah, I'll do that.
Your name is something different. What's that?
Rachit. Only Rachit@gmail.com.
The other day when I was trying to send you, I had a where is this document now? Where is this one? Yeah, share your screen.
Yeah.
What happened?
Yeah, just a minute. Is my screen visible?
Yeah. Really sorry, I can't help you in Mac, but I'll try. Okay, so download. Actually, monthly data you can.
Download for what?
I need 2 more assets, right?
Yeah.
Okay, go to BS India.
For BS India. Yeah.
Because that gives ready-made monthly data. Market data products. Not markets, market data products.
Equity.
Wait. Indices.
Analysis.
Indices, historical prices.
Yeah.
Select index.
Mm-hmm.
BSC cap 150.
Mid cap 150.
Yeah.
Yeah.
Monthly.
Mm.
2012, right? So Jan 2011. Download that. Oh no, so it is only from 17. You can't do it. Go up. Change the index to FMCG. Yeah, download it.
Okay.
Reverse sort. Select all and reverse sort. Off now.
Yes.
Delete August.
Only the close column, right?
No, delete August.
Delete. Yeah.
Now calculate right FMCG percentage.
Mm-hmm.
Do that. E2 into 100 divided by E3 minus 100.
Yes.
Get these values and paste it in the other sheet. We already have IT. FMCG. Just see any BSC strategy index is there.
Which other index?
Come down. Momentum index.
Which one?
Momentum.
It is from December 15.
No. Then select some other thing.
Just try small cap or something.
Reality is a waste. Don't do that.
Small cap or something, yeah.
Yeah, small cap.
Yeah, select. Yeah. Do the same stuff.
Okay.
Now FMCG and small cap you have to do in P headings.
Yeah.
Copy whatever is in O, P and Q. Come down.
Small cap has that division thing.
Yeah, delete the data from December 12. There's more 6 something like that. Delete that also. Because of this, that gold is coming something else, right?
Mm-hmm.
Coming as 1, maybe that. The H is gold, I suspect. Go up.
Yeah.
That's why the 1 is not come in the cup. Now it has come. We were struggling, right? Like why I'm not able to explain why the gold is
Yes.
or something like that.
Just because of that one.
Because of that extra. So now you have all of them, right? So go up.
This we have calculated D mean.
We have calculated D mean now. Change the heading to 4 port to 6 port. The down. Down.
Which
In the
one?
name of the sheet,
Yeah.
Okay, now what you need to do is go to Y and Z, Y1 and Y2, Y1 and write FMCG percentage. Or you can just simply point to P2, P1.
Yeah.
Now this is the ratios you are copying, right? Okay, we'll sort it there. Now what you need to do is that N equals to 115 is there, right?
N
N
equal.
equals to 115.
Yeah.
Select the entire N 115 and all the down items. N also, we have to select N also. And other things also. All the way up to all that.
Till
Push
here.
it. Now push 2 rows down.
2 rows down.
Yeah.
Okay.
Now, Nifty IT, there you, after NASDAQ, you write FMCG and small cap. Copy. Instead of writing, you copy from Q or something like that.
From here, right?
Yeah. You have to do that for horizontal also. No, in the first block, transpose, there you have to do 2 more blocks.
Okay.
Just to be clear, know that U1, you shift it to 1 right. So everything is aligned. U1 and yeah, push it. Now you have this. Okay, now what you need to do is come there to V3, V5.
Hmm.
V5.
V5.
Yeah.
Yeah.
Select all that block.
Yes.
Even in small cap also, it has to go 6 by 6. Now instead of 4 by 4. Now go to your formula bar.
Mm-hmm.
That will become, instead of L2 to go 16, it will become Q. Change, go to the formula bar and change.
Okay.
Now press Control Shift Enter.
Yes.
You got it, right? So now do that for where? For where? That is not V5 to divided by V12. Control Shift Enter. The same thing for STD. That will become standard deviation of J of J.
Okay.
Now product ST again you have to copy. Control Shift Enter.
Here I'll get all the ones.
Yeah, that means your calculation is right. Change it to 2 digits, all the 6 by 6 matrix. Now let the other ones be there because anyway you are not reading them because you don't understand. At least this you understand. Change everything to 1 by 6 equals to 1 by 6. Actually, that is dummy. You can return that. You can remove that.
This entire thing, this entire block.
Yeah, because this nothing is happening there, right?
The portfolio returns are calculated on based on this.
All right. So in which case you have to point that
All this
V
returns to this weight.
that one.
All these returns to this weight.
Correct. You point them to there.
And those annual returns.
Maybe just 12.
Ankit, you're changing the formula. Just remove that, or maybe you can link the below percentages with the yellow cells. Nifty like link to
Yeah, remove that
V51.
and,
V51.
I didn't want it.
Control Z. Just remove. Just undo whatever.
Okay.
And now link the cell V70, V72 with V52.
Okay.
no. What he says is delete that expected returns, weight, and annual returns.
But then,
No expected return is needed. Otherwise, sharp will not be calculated.
otherwise, yeah, sharp will not come. Right? Okay.
Maybe now we need to calculate this portfolio return formula.
No.
No.
Into W only, right? Okay, sorry. Yeah, correct. Into
Is it correct?
Yeah, this is correct.
Okay.
Just do an average on annual returns.
The average is 14.63.
Okay, your formula is correct.
Is it right?
Because it's 14.63 there also.
Here at the bottom, it is showing 14.63.
Correct.
Portfolio return is also showing 14.63.
Correct.
Yeah.
Now solve.
Now solve. So for solving, I need solver, right? Do I have that? No, I don't. Okay. Solver. Solve what?
Yeah. Then you have to add 2 more conditions. V56.
56, that is this one. FMCG.
Even by changing the variables also you have to change them. It's not V52, V55. It is V52 to V57.
Firstly, this is V52 to V57.
Yes.
Okay. Then I need to add 2 more conditions here, which is V56 is greater than equal to 0.10. Am I right?
Yeah. Add one more.
It's V57. Okay. Yeah.
Yeah, put 0.1.
Mm.
That's okay.
Okay.
Solve.
Is that all?
Hmm. Okay, change.
Changed.
It went all into NASDAQ.
Yeah. It will.
You have to put that condition also. So now these are 6, right?
Yeah.
So 6 by
1 by 6 is
10.
70.
You can't put more than 33%. So add that condition to everything. Add.
To each and every one of them?
Yeah, you have to add.
Like V52 not greater than equal to 0.33.
Correct.
Is less than equal to 0.
34.
Right?
Don't say okay. Don't say okay. Add.
Yeah.
No, do that.
53.
It was already done.
Yeah.
Now say okay.
Okay. So we have 52 greater than equal to 0.10 and less than equal to 0.34.
Hmm.
Likewise, 53, 54, 55, 56.
Yeah. What are you deleting? Double, huh? Okay.
This is double. Yeah.
Hmm.
56, 57. Okay. Yeah. Should I solve?
Hmm.
Okay. Still, it is given 0.34, the maximum to the NASDAQ.
Yeah, but increase to IT, right?
Yeah, it has increased to IT.
Go up. Maximize the sheet.
Mm-hmm.
Go up. The FMCG is not copied.
So V56 and V57. Here also I need to make the changes, right?
Into J2 plus J2
Plus G2
into
into
Z
and lock it.
plus K2 copy that. How come 18%?
You have put an and, Rachit, in.
And after J2, you have put an
Yeah.
and.
You put an ampersand instead of star.
Yeah.
Make two digits.
Sorry?
digits precision, the entire R.
Yeah.
This is much better, right?
Mm-hmm.
Take the portfolio or copy, go to backtesting metrics.
Yeah.
Paste it in G.
Yes.
My CAGR is improved considerably.
CAGR is 17%. MDD is minus 17. Standard
Both
deviation is 3.19.
torque is improved. Beta is a little higher, but that's fine. And R2 is R square is
0.43.
and I have a very, very big alpha.
Yeah.
Right, change the name to underscore your name, add. Save as.
Wait a minute.
No, let his name be there.
Done. Should I stop sharing?
Yeah. So that's how you do 6 portfolios, right? And 6 is also little overkill, but I would go for 6 because I would have some Nifty component because that's where I won't go wrong. I'm matching with Nifty. And I would add 2 sectors and 2 strategies and maybe NASDAQ or gold, something like that. So I'll get 6 portfolios and I would allocate at least 10% and get some ratio. You also could redo that exercise by going right before COVID, right? Delete all the data, only feed data up to December 2019 and check how it behaved in COVID. You would really get confidence because right now you are peeping the data into COVID as well. But delete the data and observe it. So you will know what's happening in COVID.
So this reallocation or should be done at the end of every year. That's what you suggest, right?
Doing it monthly is overkill. It just keeps adding transaction costs. And if you have additional money, what I would do is I would chase the dip buy, except gold. So if I have to put additional 10 rupees, right?
Then it should be deployed in such a way that the new ratio comes in.
No, I won't bother too much on the new ratio. What I will do is in July 2002, if I had what's happening here? July everything is up. So probably I would have put money in IT because that's the dip buy. Whereas in June, I would have definitely put in NASDAQ. Right? Because I don't want to pay premium. I mean, that's my mentality. So I keep, if I have to, because I've already allocated 100 rupees at the start of the year. Probably I get 5 rupees in every month, right? My additional savings. Or 10 rupees. I don't think 10 rupees, maybe 5 rupees. What do you say? 5 rupees or 10 rupees?
Increase amount by 5.
Yeah, so I will deploy that 5 in NASDAQ in June end. I would have had a dilemma in July end. I won't do gold, even though gold looks, whenever gold shows up least. June 21 gold is showing least. Right? Probably I would have choose 50 that month. While doing so, your ratios will go haywire at the end of December. Reset them because anyway you are getting 100 rupees, right? So it's very easy to reset. The idea here is do not pay tax. You only pay tax when you need this money.
So the idea is like instead of doing SIP in that regular fashion, do SIP like this in your selected 2 or 3 portfolios, and at the end of the year, rebalance your entire portfolio according to the weights calculated, according to the
Yes.
calculated weights.
Yes.
Makes sense.
I mean, you could, because you have the data, you could feed in, but it doesn't change much. As we have seen in this sheet, right?
Mhm.
It hardly went to 46 to 43, something like that, right?
Yes, yes. Not much of a change.
Not much of the change. Here also, it won't change much. Probably that 16, it will say 17. The 10, it might say 11.
Partha, you're not sharing the screen.
I'm not sharing. Okay. Yeah, this one. That's the thing. And I also would do one thing here. When did we start? We started in December, right? I have to do that individually. I can't do it one go. Come on. So I have information that I will underperform probably 2 out of 10 years. So I'm prepared for that. And so if 2022 shows an underperformance, I wouldn't dump the model because I know in historical data set, I have underperformed 2 years. So probably in future, I would be prepared for 3 years, 3 out of 10 years. The moment you see underperformance, right? So you'll dump the model and say it's not going to work. So stick to it for 10 years at least. If not 8 years of outperformance, you might outperform maybe 7 years, which is still good, right?
We should have a small cap and a mid cap Bs. I don't know why they don't have.
The mid cap is there.
Mid cap is there. Yeah. I think it's quality, right? Quality 50, right?
No, the plain mid cap is there, I think.
That's a plain mid cap. Okay.
Unfortunately, this year the portfolio is not doing good. So it's a clear underperformance. So from 533, we are down to 4. It's about 10% down. That's fine. As I said, like I'm okay. Yeah, actually, we are down by 11%. Whereas Nifty is up. Even Nifty is down by 2.5%, 3%. So we are down by 8% or underperforming 8% against Nifty, which is fine because we know that we will underperform in 2 or 3 years going by the historical data set. Yeah, there is a big underperformance as well there, 7% underperformance. I'm stressing that point because in December is when I went in paid manual of momentum mode. So I would have suggested some ratio like this. I'm sure if anybody has followed, I have followed and I'm underperforming Nifty in that particular asset allocation model. So I have no shame in agreeing to it. And I will continue to do it in 2022. Right?
Cora, I had a question.
Yeah.
So we keep getting a lot of new ETFs coming in, representing different stocks, different global indices. If we are sticking to the same allocation for the next 10 years, how do we incorporate the new ETFs that are coming into the market, or are we not even looking at them?
Get them. I mean, like how I chose this 6. I won't go wrong in Nifty. And then I chose 2 sectoral and 2 strategy. and either gold or Nasdaq.
But the question then comes is, if we are moving the allocations, we'll be getting charged the taxes, right?
You have to pay one time. So now you are dumping FMCG and replacing with something else, right?
Yeah. Okay.
So your FMCG, you have to either keep it as it is, and when you are getting 200, remove FMCG and see what would be the new 100 where it goes.
Okay.
I mean, keep FMCG now as a buy and hold. Don't touch into this model. Get XYZ. Now, when new 100 comes, probably XYZ might have quite a bit of allocation.
Okay, got it.
Because we are already at 500, right?
Yeah.
So even your 10% allocation would be at 50. And now you're replacing FMCG with XYZ CG. So even if that says 0.1 or 0.15, you are done all 100 into that.
Yeah. Got it.
I got a question on the tax angle in here. You mentioned that readjust during March to avoid the tax. How can we avoid tax in here? Can you explain that?
Sorry?
You mentioned that in order to avoid the tax, rebalance in March or in December.
Yeah.
So how can we avoid the tax if we rebalance in March? Is it like, short-term tax would be applicable, correct?
There won't be any tax, right?
But there will be some gains in that
That's
year.
only if you book.
But how can we rebalance when without booking it? Not getting that point.
Right?
Sorry, you are breaking.
That's what I've shown you here.
Oh, okay.
My ratio was 43:57. Next year it became 46 and 54. I'm bringing 100. So I will only buy 49 and 51.
Okay, got it. Yeah.
Something like that.
Okay, got it. Yes. Thanks.
One final template. I won't spend much time. I'm hungry, you guys are hungry, so let's finish that. And if you have any doubts, you can write to me, or most of you might be attending the next week's screener session. So ask me if you have anything. Same 4 indices, 6 indices is what I've taken here. SPY, QQ, UUP, TLT, gold, oil, daily returns. Put it monthly returns. Okay, here the actual value should have come, and here you are calculating the returns, right? Returns and the actual values are the same in this case. The first step is returns, then DV, then calculate average returns, then allocate some weights. Then there is something called diagonal weights. Then cover matrix, inverse cover. Then you have product sum, that is what W2, W power 2. Then you have average of turbulence. This is turbulence. This turbulence, this is a big formula. This formula is nothing but this one. If you understand it, it's well and good, right? So you calculate the turbulence as you go, and then you get total turbulence, which is average of this particular stuff. 0.89, 89 is what I got. And then you are solving for lower turbulence by changing the weights. W36, which is the turbulence, needs to be lower by changing weights. Constraint is it has to be 1. Sum. This is basically an application of our Indian statistics guru. How many of you heard about him?
I heard
How many
why
of you have heard of
why. Yeah, I heard it via your manual of momentum.
He is a couple of years senior to Subhash Chandra Bose in the same school. Calcutta born and all that stuff. Former Bangladesh, now Bengal. He's actually influenced by Rabindranath Tagore. Okay. And Subhash Chandra Bose is 2 years his junior. So he's basically politically and intellectually very well connected. And anyway, so he's the one who started ISI in Calcutta, and there's a branch in Chennai. So father of statistics and Padma Vibhushan. Luckily, they were given him without asking.
On his birthday, this is upper here, on his birthday, the 29th of last month, there was an article that was published on the Hindu in Chennai. I don't know.
Okay.
Yeah, let me see if I can just pull it out from the net. I'll share it on the chat here. A snippet about him on the editorial.
I don't read newspapers, so. Yeah, so this is another way to do the asset allocation. I will dig this paper and send it to you guys, this particular paper. So these are the guys who said you can apply that particular Mahalanobis distance or minimum turbulence, it's called, to financial markets. And that's the first time I've seen that paper from there. Another thing is This is my practice. Give reference wherever you are using the data. Don't hide and act as if it's your own invention. The idea there is, if you made a mistake, if other guy has a chance to correct you and correct himself as well. If you don't refer where you got this idea, and by chance if you have done any mistake in this particular calculation, there's no way you could know it, right? That's about it. So these are the various asset allocation models. These are some of the definitions. This is one thing. Now you have a better understanding than what you were in the morning. Save early, start investing very early. Right now, I don't know where you are, but I would assume you are at 100, right? You need to go to that 500 figure. It will take time. You can't go overnight. And then I said I'm a big fan of low cost funds. And right now there are about 20 participants. In India, there are about 6 crore investors. I can't educate everybody. So educate at least your close by friends or your family. The education here is it's very difficult to beat benchmark because everybody failed. There was only 15% guys who were able to beat it. So if you can't beat them, join them. And diversification. Instead of one fund, you select 2 funds or 3 funds. You might achieve an outperformance over benchmark, or you might achieve also a lower drawdown, because all the guys are not born same. So some guys would be targeting return, some guys would be targeting drawdown. Yeah, so give them the same gyan, whatever I've given. You also can in this particular thing, you do your CAGR, right? And MDD, and minimize that or maximize that common ratio, whatever people call. Just a solver. So Excel solver is very powerful. So the way that I do here is start 100 and calculate final returns. So you have a CAGR and calculate MDD in separate and do a ratio of that CAGR by MDD and solve for that CAGR by MDD, changing this component H32 and I32, right? Did you guys understand what I said or no?
Yeah.
Point is, Excel solver is very versatile. You can use it for whatever formula you want to maximize or minimize, whatever, by using some other cells. All right, guys. So I'm done with it. You can stop the recording, and I will give you 5 minutes time before we wind up.